time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
All right, this question is from Randy. Plurilock security symbol PLUR on the TSXV venture. Plurilock Security is an identity-centric cybersecurity company that reduces or eliminates the need for passwords by measuring the pace, rhythm, and cadence of users' keystrokes to confirm their identity. So essentially, it's a digital fingerprint is what they're trying to create. They operate in a highly regulated industries, including healthcare, critical infrastructure, government and defense, and financial services. Recently, on November 9th, Plurilock consolidated all of its software into a single platform just under the brand Plurilock. The stock is currently trading at 14 cents a share and a market cap of 10 million, down 69% year to date. The company did have massive increase in revenue of 103% year over year to a record of 30.8 million. But because Plurilock is extremely contract-based, their revenue is extremely inconsistent. And because of this, the revenue increase is kind of just expected with the contracts. Because the contracts are primarily dominated by their hardware sales, which is 82.4% revenue, and software only makes up 17.3%, with the remainder just being some additional side business. As hardware is more one-off, it explains the high variance in contract revenue. Net income is still a loss of 1.6 million for a quarter, slightly worse than the previous year's loss of 1.4 million. So no growth there, and you're seeing these high revenue growth. There's something going on here which isn't good to investors. The company is burning cash, as the last quarter was operationally at a deficit of 87,000, which isn't much, but it's something. But year to date is still a large amount of 6.2 million. For a market cap of 10 million, that's quite large. Further hurting the company's cash balance, it is acquiring companies, which is good in the long run, but in the short term, it has spent 3.9 million year to date. This leads us to the balance sheet. It's just not great. The company has a net debt position of 1.1 million, which on its own isn't detrimental to the company, but it has a negative net working capital basis as well. The company has 28.3 million current assets versus 31.1 million in current liability. So you're looking at this for short-term liquidity. If this goes under, even if the company is profitable, which Plurilock is not, it can spell trouble for the company, and it has often ended in bankruptcy or some sort of restructuring for many companies. There are some liabilities of 1.6 million in share compensation, but even adjusted for that, net working capital is still a negative 1.2 million. The company has an active line of credit, which is where a lot of its current liabilities are derived from. Following the acquisition of Atrion Communications, Plurilock increases credit limit to $4 million US from $2 million US on September 26th. So the numbers which I was previously quoting were from the end of September. So this credit increase hasn't even affected the balance sheet yet. You'll probably see this in the next quarter. So in the next quarter, they're most likely drawing on it right now on this line of credit. So if you saw it up to the 4 million US, which is about 5 million Canadian, that's roughly half the market cap just in the line of credit. So if they were to, let's say they were able to pay it, which right now they are cash negative, they would have to raise shares or go bankrupt. So let's say they're not going to go bankrupt immediately. They're going to start to raise shares. That's going to be massive dilution if they were to try to raise all this money, so half their market cap in shares. It's just a horrible idea. And this is on top of them already increasing their basic share count by 6% to 74 million in this year so far. And additionally, it has 17.5 million shares of warrants and options that could be diluted into shares. Right now, they're out of the money, so they probably won't be executed. And if the company continues to go down this path, they likely won't increase in share price, which means there won't be dilution. But it is something, if you were to hold this company, were to make a recovery, there's still going to be further dilution just from that. So in summary, the revenue is growing, albeit inconsistently. The company produces no profit or operating cash flow and has increasingly leveraged its balance sheet. This is not a company we invest in.
Yeah, and I actually met with management years ago, and the technology is very interesting. They displayed it, but they made several acquisitions, and at some point you gotta, like we harp on this all the time, you got to be producing cash flow. And that is what the market is calling for. That's why the share price is likely depressed. It is a negative market overall, obviously, but you need to have cash flow, and if you can't produce that despite the tremendous growth in revenues, the business, it's not going to produce meaningful cash flow per share, earnings per share, which over the long term drive the share price. We keep saying this regardless of the type of business, but when you don't see that over time, the share price will go lower. So this company has to focus on, they've done a bunch of acquisitions, there's great revenue growth, make some margin, make some actual earnings or cash flow off of that revenue growth, and the market will reward you over the long term. If you don't, it doesn't work. It's not a business at that point.
Yeah. The great revenue growth validates the fact that there's demand for the product.
Mhm.
Yeah.
But the lack of profitability shows that, the economics of the product have not yet been validated. Now, this is at least, it's a better story than, a company that has barely any revenue and a huge operating loss. But, they're still not there. They still have to validate that they can sell this product profitably.
Yeah, there's an opportunity here to get margin off it, to create per share cash flow, per share earnings. Do that, and then the market will reward you. If you don't do it over the long term, there'll be, the story that we've seen before. They'll either have to consolidate shares, or the company won't do well over the long term. You need to have profitability and create, not just growing via issuing shares, and then that's how you're funding your operations. You need to grow via cash flow at some point. Produce some of that, so anybody can value you in the market. You can't be valued if there's no cash flow.
And if you're growing revenue only by leveraging your balance sheet, that's a road that leads to disaster.
They have had some recent hiccups with I think both the Canadian and U.S. governments, so they do have demand, like you said. It's I wouldn't say it's pure leverage, but they're quite leveraged, to say the least.
Yeah.
Good. Well, we'll continue to monitor them because there is good revenue growth there, but we need to see some kind of profitability at some point.